Hey everybody, it's Stuart Smith with smallcapvoice.com, and once again I'm joined by the team at Supermassive. We've got Kevin Gray, we've got J-Rab, and Demetrius Thurston once again. We're talking all things in the market today because, boy, there's a lot on the plate. It is the dateline March 14th, 2023. Early today, the news was positive. We've had more positive news throughout the day, but as you may know, March 13th was a bit of a bloodbath based on Silicon Valley Bank and other regional banks and potentially another bank failing in Manhattan. But we woke up to the news that inflation had slowed here in the month of November 2023 since its lowest point since September 2021. So it's again showing continued signs of cooling off, making the market a little bit more bullish. But then, again, we see that the government had to step in, and this isn't really, it's nothing like the last time when we had the too big to fail crisis. But this is almost the antithesis of that, where you have the smaller regional. However, there's a lot of nuances to Silicon Valley Bank that make it very different than most regional banks, just by those who had their money deposited there and the size and balances of those deposits. So Demetrius, with all of that as the backdrop, when you look at these regional banks, and specifically in this case, Silicon Valley Bank, and the impact that it had on the market, and then with the positive news that we've had out there today with the CPI numbers, let's get your take on what's going on and what you think is really the salient takeaways from these moves.
I think that the way Silicon Valley Bank was operating was quite risky for the little guy, with how much money that people had or companies had in payroll. It has not turned out well. It was pretty disastrous in regards to their fear about not being able to make payroll this week. You're seeing all these large companies have to get ahead of the news and talk like, we have this much money with them, or we don't have any money with them. And I really do sympathize with the companies and the people that had no idea this was even a possibility. But I think strongly that the Fed needs to continue raising these interest rates, same interest rates that did lead to this, also in part to poor risk management, in order to combat the inflation that they kind of kickstarted all the way through the quantitative easing we saw from the start of COVID up until 2022.
Well, Jay, I know you don't feel as bullish about raising interest rates. What are your thoughts?
I can understand how it can be beneficial in the short term. I just feel that when you raise interest rates and raise them quickly like they are, that's going to stifle the growth of these companies. It's going to reduce the borrowing of these companies because you have that risk of having these higher costs.
I'm looking at some things that are hitting the press wire as we speak. Just more people are chiming in, and it's pretty troubling. Again, one of the most elementary errors in banking was committed by Silicon Valley Bank. We've also got Senator Elizabeth Warren asking Powell to recuse himself. And these are big things. And we also know that last night, all of Congress got together the way we all get together via a Zoom call. That's how important this was. Mm-hmm. You can look up the TikToks. I think some of them were done incredibly well, very informative, really saying this is important, that we not panic, that we understand. Because Kevin, as you pointed out, right now, the money's not coming from taxpayers to bail out this bank. It's coming from the FDIC, and that's why we have the FDIC. Mm-hmm. What are your thoughts?
I think that that's kind of an important part. And the FDIC, that fund that's put together to kind of protect the depositors, this is why it's in place. And I mean, I'm not the biggest fan of government intervention inside of the markets, and we're not going to go down that rabbit hole. But what I will say is that there is a reason why some of these companies, these banks, do need some level of regulation to prevent the zealous lending that they often get into. There's a lot of risk management that you have to go through, and when you start doing a lot of riskier loans to make a bigger profit, I mean, it's literally how you weigh owning a business: risk versus reward. What risk am I going to stomach to go after bigger and better rewards? Every small business owner has to make those decisions every single day. And a lot of times you're going to be risk adverse. These banks, when they're backed by a large amount of backers like this, they can be a little less risk adverse. And that's kind of what happened. But I think Demetrius kind of said something that was really unique. It's about companies getting ahead of this. And that's kind of where my head is at. If you can get ahead of a negative story, you can actually have success from it. There's a lot of companies that are just completely unaffected by this. They're going to be affected by it because investors rather are scared. But you know what my favorite headline that I see right now? About an hour ago, just hit Benzinga. Charles Schwab, CEO, bought 50,000 shares this morning. That is bullish. That's
Bought it of what, his own company or
oh yeah, bought 50,000 shares of Schwab. And so I'm sitting here saying that's a bullish. We look at Cooler Technology. They just released a tweet the other day saying that we are completely unattached to this whatsoever. The companies that are going out and giving their shareholders faith, those shareholders are saying, there's my hedge opportunity. That's how I can make myself a little less risky here. And I think that's how we need to be looking at this, at least from a marketing perspective or from an investor relations perspective. Get in front of the news. Even if you think you're exempt from it, find a way to get in front of the news, reassure your shareholders, and stop treating them like fodder with wallets. Get out there, make some connections with them. They will support you through market volatility. That's just my take.
Yeah, I think it's a great take. And I think, I'm sorry, I'll get right to you, Demetrius. I think it's important to point out, we're not financial analysts here. We are marketing professionals, IR professional, myself, 25 years in the business. And what you pointed out is incredibly timely as well, because these micro caps, a lot of times they say, I don't want to talk to my shareholders. They don't want to hear what I have to say. Just the very fact that you're getting out there and talking to them adds a lot of validity to not only who you are, but the message of the company. Go ahead, Demetrius.
To bounce off of what Kevin was saying, there is a speed requirement that's necessary in how information is shared nowadays. I mean, from our experience and expertise in marketing, we understand that you need to be fast when stories like this happen, and you need to get ahead of it and explain more what's going on, shed light, because even when, I mean, no bank can truly survive a bank run in any given circumstance. And with how information is shared, there was a quote this weekend during the Oscars, to paraphrase, movies take years, information takes milliseconds nowadays. And when these conversations start happening, it could be hours, and then all of a sudden everybody on any social media platform telling other people knows about what's going on. And it can be dangerous if you're not being transparent with your shareholders and those that are, a part of your company, even for people just trying to get payroll.
I think
well, thanks for that. Thanks for that today, guys. We're going to wrap it up and keep things tight and concise today because there's a lot on the table we could dive into, but we really want you to help us pick these topics. Again, we're not professionals, so we do have thick skin. So if you disagree with anything, we'd love to see your take in the comments below. For Jay, Demetrius, and Kevin, this is Stuart Smith saying thanks so much for tuning in.